This is Jody Trana with Chapter 18, which we're doing right after Chapter 4 of Business Finance. Here you can see the working capital equation, which is current assets minus current liabilities. By looking at each one of these categories as they look on a balance sheet, we can dig deeper into the components of working capital. On the asset side, we have current assets. Those are assets that should be turned into cash within a year. Cash, accounts receivable, and inventories are the primary current assets. On the liability side, we have current liabilities. Those are liabilities that should be paid within a year. Accounts payable, short-term borrowings, and accrued liabilities are the primary accounts. Some of these accounts are more liquid, meaning they turn quicker into cash or are paid faster than others. For example, accounts receivable should be collected within a month or so, not a full year. And the same with accounts payable. We are going to pay it very quickly. We won't be waiting a whole year. Managing working capital means managing these accounts. Here are some ways that we manage working capital. We want our inventory to sell quickly, and that relates to setting our sales processes, setting our prices, doing marketing, purchasing the right supplies, and other policies. Our credit policies dictate how many days we allow our customers to wait before paying us. A typical time frame is 30 days, however, many industries will vary. Whether we sell things through cash or credit will dictate how quickly the cash is recorded in our bank account. And finally, we manage working capital through our payment policies. In general, we want to get payment terms from our suppliers to allow us to wait a while before paying them. Again, a typical time frame is 30 days, but whatever industry we are in may dictate a different norm. We use several ways to measure working capital, including net working capital. That's the equation that we talked about before, the current assets minus current liabilities. We also use the current ratio. This ratio takes the same information but divides current assets by current liabilities to reflect the relationship as a ratio. My favorite is the cash conversion cycle. The cash conversion cycle is a useful and easy to understand ratio. The cash conversion cycle measures how many days it takes for cash to cycle through the business, including the purchase of inventory and raw materials, selling the goods, and then receiving money from the customers. Imagine the business activities that affect a dollar bill physically making its way through a business. First, you would have someone on the phone or on the internet placing an order for merchandise. Hopefully, we have payment terms by the supplier so we don't have to use our money just yet. All we did was place an order. The merchandise is received and goes on the shelves for sale. Finally, the merchandise is sold to a customer who's allowed to pay in 30 days. Still, no money has changed hands. Finally, we receive the cash from our customer. We immediately pass some of that cash to our merchandise supplier, who's also allowed us payment terms. That's the cash cycle. It isn't ever this clean, of course, because there are thousands of activities, and it's rare for suppliers to be willing to wait until the business gets money before they want to get paid. But this at least shows you how the cash cycle works and what is being measured. Here's another way to look at the cash conversion cycle. It better reflects the way the cash conversion cycle is calculated. Here we see the components of the cycle in 3 ratios that we have already used before in our class. The number of days it takes inventory to turn or sell, that's the inventory turnover. The number of days it takes to collect from our customers, that's the accounts receivable days ratio. And the number of days it takes us to pay our suppliers. That's accounts payable days. These three pieces together create the cash conversion cycle, or the number of days it takes a dollar bill to cycle through the business on average. The cash conversion cycle is lengthened by days that inventory isn't sold and money on sales that aren't collected. This puts a burden on cash. It means that cash is tied up in inventory and accounts receivable, and we can't use it on other things. The cash conversion cycle is reduced or improved by the amount of days that accounts payable are not paid. Delaying payment on invoices can improve cash flow, but it can also put a burden on vendor relationships. Here's an example cash conversion cycle for Walmart. The inventory turnover is 44 days. Think about what that means. It takes 44 days for merchandise to sell. That's pretty quick if you think about it. The accounts receivable days is just 5 days. That's because most of their customers pay in cash immediately. And the accounts payable days is 39 days. That means that Walmart is paying their suppliers close to 30 days, which is probably the terms that they're allowed. This leaves a cash conversion cycle of 10 days. That comes from adding together inventory turnover of 44 and accounts receivable days of 5. Then subtracting the accounts payable days of 39. It takes 10 days for $1 to cycle through the company. That's a pretty quick cash cycle. The faster the cash cycle, the better for a company. It produces more cash and operations for growth. When a cash cycle is large, like 70 days, cash is tied up in the business activities for such a long time that outside sources of cash will probably be needed to operate the business. Walmart has enough cash cycling through the business daily to support much of its operations. Here's a comparison of Walmart to some of the other big box retailers. This is from a few years ago, but it probably is still pretty accurate. Walmart is the largest retailer in the study that I was looking at. It has $1.2 billion in sales every single day. That's huge. And still, Walmart is able to convert cash through the cycle in under 10 days. That's awesome. Target's cash conversion cycle is 27 days. That means that they have tighter cash flow and they need more working capital cash than Walmart. Costco's days is even better than Walmart. It's half. This could be because Costco has a more targeted customer base with more specific product offerings, and they have a more strict payment policy. This is my absolute favorite example. Amazon.com is the outlier. They have a negative cash conversion cycle. Now, the word negative always sounds like a bad thing, but a negative cash conversion cycle is great. That means that people are putting money into Amazon's pockets before Amazon pays anyone else. This is great for Amazon. So let's look at the pieces. Amazon holds inventory or turns their inventory every 29 days. Plus, it takes them 11 days to collect their receivables. So that's 40 days in total. But then they take 54 days to pay any of their suppliers. That's how they achieve their negative cash conversion cycle. You don't see this often, but definitely it's a win for Amazon shareholders because it means that cash is available for growth. The people who aren't too happy are the suppliers that are waiting on their checks from Amazon. I want to show you this graphic that also reflects the cash conversion cycle and the operating cycle, because this is the graphic that you will see in your Pearson materials. Let's take it one piece at a time. First, looking at the company that holds its inventory for 91 days before it's sold. That's an inventory turnover of 91 days. Our cash is tied up or being used by inventory during these 91 days, and it can't be used for anything else. To inventory, we'll add our average collection period. Not only has our cash been tied up in inventory, but it's also tied up or being used by our customers because we've sold them goods, but we haven't collected any money from them. For this company, it's taking 85 days to collect money that they owe to us for products that we've sold to them. Right now, our cash is being used for 176 days and not available to us for anything else. But this isn't the whole story. We also use other people's cash. Before we take a look at how we are going to reduce this, I wanted to point out that these two things together are called the operating cycle. So this company has 176 days in their operating cycle. Now let's look at how we can reduce that. From the 176 days, we can reduce that number of days by using other people's money. It takes us 61 days for us to pay our suppliers. That's our accounts payable deferral period. This helps to reduce our operating cycle. When we take all three of these ratios into consideration, we can see that our cash conversion cycle is 115 days. That's because we've used other people's money for 61 days. You need to remember that inventory and accounts receivable increase our cash conversion cycle, and accounts payable reduces our cash conversion cycle.